Welcome to Your Pathways to Wealth, the podcast where we explore what wealth truly means, because it's different for everyone. I'm Charles Massimo, and along with my partner Peter Anastasian, we'll dive into strategies, stories, and insights that help you define, grow, and enjoy your wealth on your terms. So let's navigate this journey together.
Join Charlie and Peter and their guest experts as they venture to help you continue to grow your wealth.
Peter, remember the expression beer muscles? I may have experienced this my couple of days or times in my college days where I have a couple of beers. I think I'm a lot stronger than I truly am, and I wind up getting into a fight with someone I probably shouldn't have.
Right.
Well, this is when we go through market cycles, when we go through up markets, I like to call investors that have beer muscles. And what I mean by that, they start taking on more risk than maybe they should have. And all of a sudden, when the markets start to turn down, as we're currently experiencing, they realize maybe those beer muscles didn't work to their advantage. And today we want to talk about that a little bit. And I want to ask three questions for our listeners to think about. The first one is, when you see your portfolio decline, do you feel confident or do you feel anxious? The second one, do you truly understand the risks in your investments, or are you now realizing you may have been overexposed? And third, are you reacting emotionally to short-term losses, or do you have a long-term strategy you trust? And how you answer these questions is how you should determine whether your investment strategy is truly aligned with your risk tolerance. Peter, we've seen this every time, every market downturn. Do you think this market downturn is any different than anyone's in the past?
No, I mean, the only difference is the headline. I mean, as we know, the market downturns are market downturns, and they're here and they're common and should be expected. But aside from that, it's always going to be a different headline along the way.
Yeah, I totally agree with that. And people always say, well, it's the markets, it's the markets, it's the markets. Well, your results as an investor really has very little to do with the markets, but it has everything to do with you. And certainly we've seen many times in the past. And just think about this. If you were born before 1973, which most of our listeners have, even Peter was born before 1973, you have to think about it, that the markets were cut in half three times. First in 1973 because of the oil embargo, then in 2000 because of the dot-com bubble, and then in 2008 because of the financial crisis. They were cut in half each of those times. And think about where the S&P was then, and think about where it is today, realizing that, as Peter said, headlines may be different, but the outcome is normally or always the same, and we're always onto a new bull market eventually. But Peter, why do you think people have short-term memories when it comes to that, or it's very difficult to realize that markets can get cut in half, yet we're still going to go higher?
Well, before I go into that, I definitely want to clarify that I was born a couple of years after 73. So I just want to clarify.
Come on, man. I wanted to make myself feel like I was younger than I actually was.
Right. But getting back to short-term memory, you know what it is? I think as we go on and investors, what are some of our goals as investors in general, right? For some, it's more about making money and are driven by that. And for others, it's really about planning. But let's take a step back and saying, okay, if we're driven by appreciation of dollars and ultimately feel that that's what's going to drive our ability to achieve our goals, and we tend to invest in individual securities, perhaps things along those lines. So take an example, let's say Tesla, right? You might have owned Tesla for 10 years or 15 years and certainly have done very, very well along the way. And every year that goes on, you certainly have experienced ups and downs along the way, but you feel more and more confident, right? This is just going to continue, and it's going to continue, and it's going to continue. And it very well may, right? I think, Charlie, you would agree it's anyone's guess whether it will continue or not. But the bigger question becomes, to what degree or to what point am I overexposing myself on the dollar amount versus my overall portfolio? And the reason why that's so important is this. if your individual stocks represent 50, 60, 70, I would even say 30% for that matter, but let's play it out to more of an extreme, and they're very concentrated. As investors, we're making other more permanent decisions around that, right? Imagine retiring based on the value of your individual stock or two that you've done very well in, or purchasing a second home or a larger property. But to your point, Charlie, the big question becomes, well, what happens if that stock goes down 30 or 40%, right? How would you feel if that happened? And what goes through your mind, Charlie?
Yeah, and it's so true. And so many times we'll see a client for the first time that says, well, I want to carve out money for myself. And they always say, I want play money. And I always think to myself, well, this is your financial life and you want to play with it. And somewhat to Peter's point, we always say, well, if you have play money, make sure it's money that if you lose it all, it does not impact your lifestyle. Because again, as Peter said, we don't know what the next move in the market is. I could probably tell you what the next move is in 10 years from today, meaning the markets will be up in 10 years, but I don't know what's going to happen the next day or the next week, honestly. And to overexpose yourself into any one stock where you don't know where it may be in a day, and if that one stock, you lose it all, can impact your lifestyle, well, then you really need to think about, why am I doing this? What's the reason behind it? And Peter, again, taking a step back, we think one of the things that will help most investors, we have a couple of things that we think will help most investors get through this, but one thing is having that plan. We always go back to the plan, because when you think about it, if you create your allocation to support your plan and your plan doesn't change, nor should your allocation, and nor should the anxiety around the volatility change during any market cycle. And Peter, how many times do we go back to the plan with our clients?
Always, right? I mean, without a plan, what are you left with? And I think to your point, we tend to lose sight at times as investors. We'll feel overconfident, but knowing that we have a plan in place, if you're going into retirement or you're in retirement, should your question be, well, am I looking to double my money, or do I have enough money to last me the next 3, 4, 5 years without market impact? Certainly you want to have dollars well beyond that, and we do for our clients, but it's more a matter of, I don't want to be tied to the markets emotionally. And we as investors lose track of that, right? When things are great, we love it, right? But when they're not, that shouldn't change your mood. And as time goes on, these headlines come out, and now it's all geopolitical, whether it's the war in Ukraine and Russia, or whether it's tariffs, interest rates, slowing economy, hearing of rumblings of recession. I mean, that stuff should not keep you up at night as an investor. It just shouldn't, but it does. So we know that, and we understand that. To your point, Charlie, without a plan, it makes it far worse.
Yeah. And understand this, we do not discount any of the anxiety that anyone must feel. Peter and I go through it. I mean, we feel the anxiety of, whether President Trump is going to change the tariffs, pause the tariffs. There's certain anxiety around that. That doesn't mean we change how we think about the markets, but it certainly creates anxiety. And without that plan, you're going to have even greater anxiety. But by having that plan and realizing that if you 10% decline, or even sometimes a 20 or 30, it does not take you off your plan, because you are still on track. But now, if you don't have a plan and don't realize, if I'm down 30%, well, what does that mean for the next 20 years of my life? So again, it's getting back to that plan and making sure you continually think about the plan, think about the allocation around your plan, again, how it impacts your life. And Peter, one other thing that I think sometimes helps clients, and again, we're not individual stock pickers. We certainly own individual stocks for our clients, but whether it's stocks or the markets or index funds, it doesn't matter. Instead of thinking about investing in stocks or investing in the market, if you took the phrase, I'm investing in 500 of the largest, most profitable companies in the world, that may change the psychology of how you think about downturns. Because during downturns, is Home Depot any worse of a company? Is Walmart any worse of a company? Is McDonald's any worse of a company? They're all great companies. They experience downturns, but that's just a cycle. And Peter, do you think that helps our clients sometimes when we change the phraseology?
I do. I mean, this is all psychological, and I know you're just giving an example of 500, and as you know, we own well beyond that. But the point being is, when you own few versus many, the biggest difference is when I own a few equities or stocks, I don't know if they're going to sit down for quite some time and come back, and I don't know the timing of the comeback. Whereas when you own a lot more and are more broadly diversified, that's not as big of a concern, right? You may not see the same upside, but you're not worried about it sitting and not doing much for a very long period of time. So, for us, it's I think investors have to realize what stage of life they're in. And is it about accumulation or is it about sustainability of their lifestyle and income? Huge difference. Huge difference. When you're working, great. Look, you should buy a couple of stocks here and there. I mean, why not? Why not? But if you're going into retirement and you're basing the next 25, 30 years of retirement on a couple of companies, that's probably as big of a risk as you'll ever take in your entire life at probably the worst time of your life. And so you have to really give consideration to that. And I think the main point of this conversation is really built around, what am I really trying to accomplish? Fortunately, the market downturn really hasn't been so bad at this point in time, and which will bring up, I think, part of our next conversation. But it's more a matter of, it should start giving thought to your exposure into your portfolio as well.
Yeah. And the other thing as an investor, again, whether it's index funds or individual stocks, you have to have patience. When we see clients that come to us in their 60s and they've accumulated 8, 10, 15, 20, $30 million in investments, that did not happen overnight. That happened over long periods of time, living with the ups, living with the downs, but staying disciplined. And if you want to pick an individual stock, you can pick AOL, Tesla, no matter where you want to. NVIDIA may be a little bit of an anomaly, but certainly in 2022, NVIDIA was down 73%, right? So you had to be pretty patient to realize the returns after that. But again, any stock, any index, they're going to go through ups and downs. You have to remain patient to get the full returns of the market. You cannot pick and choose when you want to own it and when you want to be out of it, because we always say, if you're going to get out, it's anybody's guess on when to get back in. And Peter, to your point, the markets are down. When we look at our portfolios, just talking to a client this morning, and here we are, depending on when you watch this podcast, it's March 12th. Portfolio is down 1.5%. And she said, wow, that's not so bad. The news made it sound like I was down so much more. And again, you always have a good thing, Peter, of why people think they're down so much more than what they truly are.
Yeah, I mean, we tend to look at our portfolios, whether we like it or not, and whether we tell our clients not to, at times, either on a daily basis or even weekly basis for that matter. And, we always say, I wish clients could only look at their portfolio once a year, January 1st of each year. Either you're up, either you're down, and that's it, or flat for that matter. But what happens throughout the year? We started off the year very strong. Portfolios just, in the markets in general were up 7-8%. And then now they're down 3-4-5%, just the general market in itself. And as an investor, what are we basing our feelings around? Well, my portfolio dropped 10% from its high, and this is really, really bad. Well, if you were down 2% or 3% on January 4th versus the beginning of the year, you'd say, well, that's just the normal beginning of the market. But when you start looking at it daily and you see the high point versus the low point, now you're increasing your emotions as an investor. And so it's just important to realign your portfolio based on what you're trying to accomplish and not worry about the day-to-day movements. And to your point, Charlie, the only way you're able to accomplish that is through having a plan and knowing what the plan is and being able to articulate that plan to even your family members and helping them understand that plan is in place. Because if you can't do that, then you really don't understand the plan that you have in place.
Yeah. And the other issue we have, well, not issue we have, I think that clients have or investors, there's a difference between temporary and permanent. When you look at your portfolios and they're down, that's temporary. If you sell, that's when it becomes a permanent loss. And again, it's these little things to realize that, again, what you see on paper, if it's negative, it's only temporary, because we all know that things eventually will come back up. It's just that we don't know when. So it's these little things to really focus on. But having said that, and Peter and I are huge believers in this, life is too short. You need to sleep well at night. So if you say, hey, I just can't take the volatility of my portfolio, regardless of where it is, you have to change your portfolio, and you have to change it permanently. Again, you can't then say, oh, the markets are better, I'm back, because we know eventually we'll have that downturn. I mean, historically, other than really the past few years, historically, the market goes down 20 to 30% every 5 to 6 years. We just really haven't seen it recently. And you have to be aware of that. So you are going back to aligning the portfolio with what makes you feel good, even if that means sacrificing returns, even if that means sacrificing lifestyle. If it's going to make you sleep better at night, having a much more conservative portfolio, we're the last ones to tell you not to do that, as long as you know the consequences that come along with that. And Peter, that's a conversation we have with our clients all the time.
All the time. And again, it's coming to grips and understanding that I can't have it both ways. I can't ride the market all the way up and participate 100% on the upside, and at the same time, when the market turns and goes down, that I'm going to avoid that. You just can't have it that way as an investor. So it's reprogramming your emotions and reprogramming your vision as an investor, and saying, I get it. I personally can't withstand a market downturn of 30-40% emotionally. And so I'm coming to a point in my stage of life where I'm okay earning, my 8 or 10%, whatever it may be, recognizing that I'm not going to have the full downside risk of the markets. It's just a different phase of life. And until you get to that point, it's going to be very, very difficult to continue to navigate.
Yeah. And again, there are certain things in investing that never change. Right? Peter mentioned diversification. Let's touch on that for a minute, because we think this is so vitally important. Sometimes people really don't understand what diversification means. And what I mean by that is, we'll see a new client and he'll own literally pages of investments, And he said, well, I'm pretty well diversified, and I didn't protect me in the down market. Well, you would diversified amongst mutual funds or ETFs. They all do the same thing in up and down markets. You aren't diversified amongst asset classes. And that's where diversification comes in. So equities are an asset class, bonds are an asset class, cash is an asset class. Just to keep it very simple, we could break it down further than that. So when you're diversified, that means you have some equities, you have some bonds, and you have some cash. And the reason for that is because historically, when equities go down, bonds should help buffer that volatility, and certainly you have cash. And the other reason why you want to have that diversification, because you do want to have cash available during downturns to be able to either put into the market during downturns or live on, so that you don't have to take from your equities during down markets. So understand what diversification is and why it's so meaningful in an investment portfolio. Peter, there's certain other things that are really evergreen when it comes to investing, right? We said patience, we said diversification, but again, it's also thinking long-term always.
Right. But you brought up a really good point. And I think that main point is, as an investor, you're never going to be happy with all parts of your portfolio at the same time. It's impossible, unless you're just one asset class and that's it. Again, let's play it out. You have cash, and you have quite a bit of cash in your account for a specific purpose because you want to make sure that the dollars are available to you for the next several years of your retirement, and the markets are up 30%. You're not going to be happy with your cash portfolio at that time because you're saying to yourself, oh my gosh, I just missed out on a 30% market increase. And now do vice versa. Well, if the market's down 30% and you own cash, now all of a sudden, you're so happy you own cash. And if you own a piece of property on top of it and so on. So as an investor, coming to grips in the fact that you'll never be happy on every part of your portfolio, including including equities in itself. There's reasons why you own international, emerging, US, value, growth. They don't all go up at the same time, nor should they as well.
Yeah. And the other part of when we think about diversification and how we lay out a plan, it's why we're kind of big in what we call our bucket approach. We could call it many different things, but it's really segmented parts of your assets for different reasons. Again, we have enough cash to get you through 3 to 5 years worth of living expenses. Then we have some midterm type of investments and long-term type of investments. And when you set your investments up that way, it's very difficult to get caught, meaning that you don't have enough capital to live through a market downturn, which is why, again, people say they want to own 100% equities, but really, is that the prudent thing to do, own 100% equities, when we know there may be some short-term pain that we need that liquidity in our portfolio to be able to take advantage of when we need it, and getting back to that whole long-term thing, whether you're 20, 30, 40, 50, or 60, you have to have some long-term perspective, right? Because even at 60, most likely, many of us are going to live a 30-year retirement. Right? That's fairly long-term. So again, if we're only thinking short-term, we're always going to get anxious when the markets go down. But if we always have that sum of a long-term perspective, we'll realize, believe it or not, we do have time to recover in the market again. If we broke up the buckets, if we allocated amongst asset classes, not just amongst stocks, we'll always have that time to be able to recover from really any market downturn. So Pete, if you're going to take your crystal ball and shake it and rub it, what would you say?
I would say invest with a purpose. At the end of the day, don't invest and the purpose shouldn't be just to make as much money as possible. Invest with a purpose, have a clear plan in place, and understand and simulate the risks involved. What if this specific stock that I own that represents 60% of my portfolio drops by 40%? Simulate it, see how you feel, because by the time you go through that, it's too late. So you sort of have to be ahead of it at the end of the day.
Yeah. And the last thing I'll say also, don't compare yourself to your neighbors, right? How many times people say, I'm up 30%, up 40%. Well, how did you get there? What did you really do? And what about the times you were down 30 or 40%? What I mean by that is your portfolio is your portfolio. Your goals are your goals. They're not your neighbor's goals. So focus on you, focus on where you want to be, but most importantly, focus on having the best life possible, and then build your plan and build your portfolio around that. So if you want more information about ways to overcome downturns, please feel free to reach out to us by going to yourpathwaystowealth.com, or you can always call us at 631-777-1030. So until next time, don't let the short-term stuff get you down, and get out and enjoy spring, which is right around the corner.
To connect with Charlie or Peter, visit them at yourpathwaystowealth.com or call them 631-777-1030. That's 631-777-1030. The material and the opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual or entity. To determine what is appropriate for you, please contact your financial professional.